Welcome to Breaking News to Trading Moves. Today we're focusing on a major event in U.S. regional banking. Pinnacle Financial Partners has officially completed its merger with Synovus.
That's right. And this creates a really powerful competitor in the Southeast. We're talking about a bank with about $117 billion in assets.
So our mission today is to give you a shortcut. We want to distill the immediate trading consequences and, map out the new competitive landscape. We need to figure out who benefits and who might be facing some headwinds now.
Exactly. This deal closing is an important moment for the whole sector. It kind of resets the standard in the Southeast. For you, the listener, understanding this isn't just about one bank.
Right.
It's about recognizing the dynamics that will likely drive regional bank stocks for, well, the next several quarters at least.
Okay, so let's start with the specifics. The transaction is done. The combined company is operating under the banner of Pinnacle Financial Partners, Inc.
PNFP, yep.
So for those of us who, live near the actual branches, what changes immediately? On the ground.
Honestly, very little in the near term. They're being very deliberate about this, taking a phased approach.
So you'll still see both names for a while.
You will. The bank will operate and market both the Pinnacle and the Synovus brands. It's a dual brand strategy, and the whole point is to minimize any client confusion. They want to avoid retention risk.
And when does everything become just Pinnacle?
The full consolidation, when every branch switches over to that single Pinnacle brand, is scheduled for early 2027.
Early 2027. That sounds like a pretty long runway. Doesn't that timeline, present an execution risk for investors?
It absolutely does.
Amazing.
But it also shows just how complex this is. Merging two large organizations that have overlapping footprints. They're choosing stability over speed.
Okay, so for investors, what's the immediate trading consequence?
The immediate result is that the combined company now trades only under the ticker PNFP. The old tickers for Pinnacle and for Synovus, they've been delisted. They're gone. PNFP is the only way to participate now.
Beyond just the scale of it, the $117 billion size, what does this completion signal to the broader financial market?
It provides a lot of psychological support. We've seen a few large regional mergers get done recently, and this one, with two such sizable players, really confirms that consolidation is achievable.
So it gives other banks confidence.
It signals to investors, and I think more importantly to other bank boards, that the current regulatory environment allows for these types of large-scale deals. It suggests the M&A pipeline is, truly reopening for regional banking.
Scale is definitely the word here. How does this increased size actually give PNFP a real-world advantage against its peers?
I'd say it gives them three major advantages, especially in those growing Southeast markets. First, they can compete for higher-end corporate clients.
With better services like treasury management.
Exactly, more sophisticated treasury management. Second, it boosts their specialty lending. Think niche markets like healthcare or certain types of commercial real estate.
Okay, and the third?
This might be the most impactful one. Talent recruitment. Top commercial bankers, they want to work on bigger, more complex deals. A larger platform like PNFP can attract and retain those key revenue producers who might have otherwise gone to the money center banks.
So the deal is closed, the new PNFP is trading, and they have these advantages of scale. For shareholders, the focus now shifts completely from the deal to the work. What specific risks will drive the stock's performance from here on out?
It is all about execution, 100%. The market is going to be scrutinizing four areas very intensely.
Okay, what's number one?
Client retention. They have to make sure commercial clients don't get frustrated during all the system conversions and take their business somewhere else. Second, the technology conversion has to be successful. That's always a high-risk process.
Combining two different banking systems sounds messy.
It can be. Third, they have to actually achieve the cost savings they promised the market. And finally, managing their funding costs in what is still a pretty competitive deposit environment. Success or failure in those four areas will really dictate the valuation for PNFP going forward.
All right, let's turn this into actionable knowledge for you, the listener. We've identified three categories of winners that could benefit from this consolidation.
The first category is the most direct one. The scale winners in Southeast regional banking. Obviously, PNFP is the primary winner, but the market often rewards their peer group too.
You mean other banks that are also demonstrating that kind of efficient growth and market dominance through size?
Precisely. We're talking about banks that can spread their technology and compliance costs over a much larger base of deposits and loans. They're just running a tighter ship at a bigger size.
So beyond PNFP itself, who should be on that list?
Well, you should keep Regions Financial Corporation, that's ticker RF, And Fifth Third Bancorp, FITB, on your radar.
RFM-FITB.
Right. Regions, for example, has had a massive footprint across the South for a long time. This deal just raises the competitive bar, which kind of validates their existing strategy.
And what about Fifth Third?
Fifth Third, FITB, has been really strategic about expanding its wealth management and capital markets arms, which complements its commercial banking scale. So they're also well-positioned to meet this new competitive baseline.
Our second category of winners moves away from the banks themselves and looks at the professional services side, the M&A and capital markets advisors. Why is one big merger help them?
Because bank boards are, by nature, pretty conservative. So seeing a complex deal like this get over the finish line provides a lot of encouragement.
It shows them it can be done.
It shows them it can be done. It might validate the strategy for other executives who are maybe hesitant about regulatory approval or integration risk, and that belief generates more advisory fees and underwriting work for the firms that specialize in these transactions.
So which firms are we talking about here? Who's positioned to capture that activity?
We're tracking Piper Sandler companies, ticker PIPR, also Evercore Inc., EVR, and Lazard LAZ.
PIPR, EVR, and LAZ.
Yep. These firms have deep industry expertise. They're always involved in these multi-billion-dollar deals. If the pace of consolidation picks up, their fee income visibility improves a lot.
And the final winner category is one that's essential for integration, but is, I think, often overlooked: the technology and cybersecurity vendors.
Absolutely. This is all about integration spending. Just think about the infrastructure you need for a $117 billion bank.
It must be enormous.
These large mergers are incredibly costly. They require multi-quarter spending to unify and upgrade core operational areas. We're talking modernizing core processing, enhancing digital banking platforms, strengthening fraud controls, and critically hardening cybersecurity across the whole new platform.
And that spending is a direct revenue boost for their vendors, so who benefits?
This spend flows directly to the providers. We're watching Fiserv, Inc., that's FI, also Fidelity National Information Services, Inc., FIS.
FI and FIS.
And in cybersecurity, a name like CrowdStrike Holdings, Inc., CRWD. The need to standardize and secure these newly combined systems means a firm like CrowdStrike benefits from that immediate requirement to provide a uniform enterprise-level security architecture.
Now let's switch perspectives. For every winner, there's often someone else feeling the pressure. We've also identified 3 categories of losers who are now on the defensive.
And the first category is feeling that pressure right away. The Southeast peer banks competing for the same commercial clients and, just as important, for the best banking talent.
Because the new PNFP platform can now put downward pressure on loan pricing, go after larger clients, and attract those top revenue-producing bankers we talked about earlier.
Exactly. This is really tough for peers who might have already been stretched for talent. These are the banks that will feel the competitive heat first. We're looking at South State Corporation, SSB, Cadence Bank, CADE, and United Bankshares, Inc., UBSI.
So if you hold stock in those names, you need to be watching their quarterly results closely.
You do. You need to monitor their lending margins and their recruitment costs because they're now forced to compete with a much larger, more capable rival in their key markets.
The second category seems to be about geography. Community in mid-cap banks in markets where PNFP is now dominant. This sounds like a margin squeeze situation.
It is. This is all about the battle for deposits. When a larger bank like PNFP gets aggressive about gathering deposits, maybe with better tech or higher rates, the smaller players in those same towns might have to raise their own deposit rates just to hold on to their customers.
And that directly hits their profits.
It squeezes their profit margins, yes. It slows their growth because they're paying more for the very money they use to make loans.
So these are the banks where we might see their net interest margin, their NAM, come under pressure.
That's the metric to watch, net interest margin. NI is the core measure of a bank's profitability. If they have to pay more for deposits because of new competition, their NIM suffers. Banks that are sensitive to these local pricing wars include FB Financial Corporation, FBK, Service First Bankshares, SFBS, and Renascent Corporation, RNST.
Okay, our third and final loser category highlights banks that have what the market calls higher beta deposits. We hear this term a lot, but for the listener, what exactly does higher beta mean here?
It's all about how quickly a bank's deposit rates react to changes in the overall market. A higher beta deposit is just money that's less sticky.
That's loyal money.
Right. It means the clients are highly sensitive to price. These are the customers who will chase the highest rate possible and will move their funds pretty quickly for a better yield somewhere else.
So if PNFP's presence intensifies deposit competition, banks that rely on these less sticky funding sources are the most at risk of margin erosion.
That is the mechanism of the risk, yes. If competition heats up across the region, these banks will feel the net interest margin pressure much more acutely. This can lead to weaker earnings momentum compared to peers that have really stable core funding relationships.
And who falls into this category?
The banks that need to worry most about deposit stickiness right now are Bank United, Inc., BKU, First Horizon Corporation, FHN, and the First Bank Shares, which is FBMS. Their funding mix just makes them more vulnerable to this kind of competitive pressure.
That gives us a really complete picture of the market reaction. So as this whole integration process plays out over the next few years, what specific factors should you, the listener, be tracking to gauge how successful this combination actually is?
I'd say there's a 4-point checklist for the next, say, 12 to 18 months. First, listen very closely to what management says on their earnings calls,
About cost savings and synergies.
specifically about their projected cost savings, how they report client retention rates, and any expected revenue synergies. That's what will validate their integration model.
And that commentary will certainly set the near-term expectations for the stock.
Absolutely. Second, you need to track for any early signs of deposit pricing pressure emerging in the broader Southeast region, especially as we get into early 2026. That would confirm the competitive pressure we mapped out is materializing.
And since the full rebranding is still a couple of years away, we'll need some intermediate goals to watch.
Correct. So third, track their progress on integration milestones and listen to management's expectations for the system conversion, especially as they get closer to that early 2027 timeline. Any delays there would create immediate investor concern.
And finally, the routine updates.
The fourth point is to just pay close attention to any updated guidance and synergy timelines they provide during those quarterly earnings calls. That's the moment where the execution reality has to meet the prior promises. Any revision to guidance will move the market.
So what does this all mean for the combined PNFP as they move toward that 2027 consolidation? I guess the core challenge for the executive team is balancing two conflicting goals: efficiency and stability.
That's a great way to put it.
I mean, achieving those full cost savings often requires aggressive integration cutting systems and people quickly. But that same aggressive process can dramatically increase the risk of losing clients, especially those sophisticated commercial clients. The ultimate measure of their success here will be the degree to which they can realize those promised efficiencies while at the same time maintaining really robust client retention rates.
And remember that this discussion is purely the opinion of the author. This is not financial advice, nor is it a recommendation to buy or sell any security discussed, including PNFP, RF, FITB, PIPR, EVR, LAZ, FIFIS, CRWD, SSB, CADE, UBSI, FBS, FFPS, RNST, BKU, FHN, or FBMS. Please conduct your own due diligence before making any investment decisions.